In March of 2025, the man who runs the single largest pile of money on Earth sat down to write his annual letter. BlackRock manages around $14 trillion. When its founder talks, markets read every word. And he wrote one sentence that should have been much bigger news than it was. Every stock, every bond, every fund, every asset can be tokenized. And if they are, he said, it will revolutionize investing. Here's the number he did not put next to it. Today, after years of headlines, the total value of real assets actually living on a blockchain is about $32 billion. That is it. So this is the bet on the table. Wall Street thinks $32 billion turns into $5 trillion. This is why they believe it and what it would actually take. Start with the number in the title. In June of 2026, Citi, one of the largest banks in the world, published a report called Tokenization 2030. Their base case, the tokenized securities market reaches $5.5 trillion by the end of the decade, up from about $17 billion today. That is the line everybody quoted. And this number is not new. Citi first floated $4 to $5 trillion back in 2023. They just looked again and raised it. Here's the part nobody quotes. Citi's own range for that same forecast runs from $2.7 trillion at the low end to $8.2 trillion at the high end. One bank looking at one market, unsure by a factor of 3. And it gets wider. Zoom out to the rest of Wall Street and the disagreement is almost funny. McKinsey, the cautious one, says around $2 trillion by 2030. Standard Chartered says $30 trillion by 2034. Ripple and the Boston Consulting Group land near $19 trillion. These are the most serious institutions in finance, and their forecasts disagree by a factor of 15. When the smartest money on Earth cannot agree within 15 times, that is not noise. That is the story. So the obvious question, is anyone actually building this, or is everyone just writing reports? Turns out they are building it, and not with toys. BlackRock launched a tokenized treasury fund. It went from zero to more than $2 billion in under 2 years, and paid out around $100 million in dividends along the way. Real fund, real money, on a public blockchain. But the biggest number in all of tokenization does not belong to a crypto company. It belongs to a bank. JPMorgan's blockchain has processed more than $3 trillion since it launched, and it moves about $5 billion every single day. While the internet argued about coins, JPMorgan quietly built a rail running at the scale of a national clearing system. And they are not alone. Franklin Templeton, Apollo, Citi, all running live tokenized products with institutional money behind them. So why do they want this? Fink put it simply. With tokenization, markets would not need to close. Transactions that take days would clear in seconds. And the billions currently frozen in settlement could go back to work immediately. His analogy is the one that sticks. If the old system, SWIFT, is the postal service, then tokenization is email. The asset just moves. And this is not theory. JPMorgan now runs short-term lending deals on-chain where settlement is timed to the minute. The New York Federal Reserve has documented these tokens being used, right now, as collateral. The plumbing works, which makes the next fact strange. If the giants are in, and the technology works, then why is only $32 billion actually on-chain? Here's the catch nobody prints on a slide. That $31 billion measures issuance, not trading. Most of it is parked in funds with a handful of holders and almost no secondary market. The assets exist. The market for them barely does. They built the product. They never built the trading floor. So the real bet is not on the technology at all. It is a bet that the buyers show up. Look at the gap honestly. Forecasts in the trillions, about $32 billion measured today. The real market is roughly 1% of even the most conservative case for 2030. And look at what actually works. Almost half of that $32 billion is tokenized US Treasuries. Cash-like, yield-bearing, frankly boring. The exciting stuff, the tokenized stocks and real estate and private funds, has barely moved. And here's the irony. The one piece of this that did explode is stablecoins. Digital dollars, now worth around $300 billion. That is 9 times bigger than everything tokenization was supposed to move. The money rail arrived, the asset rail is still waiting on it. The honest voices in finance know all this. McKinsey, even while calling tokenization a tipping point, says broad adoption is, in their words, still far away. And they name the problem exactly. It is a cold start. No liquidity means nobody wants to issue. No issuance means no liquidity. Everyone waits for everyone else. We have also been here before. The first asset tokenization happened back in 2017. McKinsey itself wrote that tokenization was poised for success 6 years ago. And then it simply was not. The Financial Stability Board, the body that watches for the next crisis, says plainly that many of the promised benefits are still unproven. In 2022, BCG guessed the 2030 market at $16 trillion. Reality is a rounding error against that guess. So, fair question. Is this just the same hype cycle in a nicer suit? Here's the case for why this time is different, and it is not about the technology. It is the law and the plumbing finally catching up. In January of 2026, the SEC said something that sounds boring and is actually enormous. A security does not stop being a security just because it is tokenized. That is not a loophole, it is permission. The rulebook now has a place for this. Then the marquee move. In March of 2026, the SEC cleared NASDAQ to trade tokenized stocks, with the same rights on the same order book as normal shares. The first major US stock exchange to do it. The company that settles nearly every American stock got a green light to run its own tokenization pilot. The dollar side went legal too, with the first federal framework for stablecoins. And this is global, with Europe and Hong Kong both widening the door. Notice what that list actually is. It is not traders gambling on a token price. It is exchanges, regulators, and the core plumbing of the financial system rebuilding the pipes. That is what a real bet looks like. You do not rewire the rails for a fad. So why $5 trillion? Because for the first time, all 3 things are true at once. The technology works, the law allows it, and the biggest players are committed to building it, not just talking about it. But the bet has one unsolved variable, and it is the honest heart of this story. The question was never really whether assets can be tokenized. We know they can. The question is whether anyone will trade them once they are. $5 trillion is, underneath all of it, a bet that liquidity follows issuance. And if you are the one planning to tokenize something large, that is the whole lesson. Your bottleneck is not the technology anymore, and it is not the lawyers. It is liquidity and a real base of buyers. Design the cash leg and the secondary market first. The mint is the easy part. The rails are built, they are legal. The next 2 years decide whether the trading shows up, and which asset class is the first to truly cross over, past treasuries into everything else. That is the moment worth watching. Subscribe and we will follow the money and show you the first asset class that proves liquidity can follow tokenization, the day it happens.